What happens when you write checks against a bank account that is almost empty? You get caught, the checks bounce, and the game ends. Now replace checks with futures contracts, replace bank account with silver vaults, and replace bouncing with a full-blown crisis that could reshape global precious metals markets forever. Welcome to December 2025. Western banks just discovered they are holding the bag in the biggest silver squeeze since the Hunt brothers tried to corner the market in 1980. Except this time, nobody is manipulating anything. The metal is simply disappearing. I am going to show you what happened in the first 4 days of this month. Over 47.6 million ounces of silver were claimed for physical delivery from Comex vaults. That is not a normal month. That is not even a busy quarter. That single wave of delivery requests represented more than 60% of Comex's total registered inventory, the metal that is actually available for delivery to contract holders. Analysts started using a term you don't hear often in commodities markets, vault drain emergency. Think about what that means for a moment. Comex is supposed to be the backbone of silver price discovery for the entire Western world. It's where industrial users hedge their needs, where banks manage their positions, where investors gain exposure to precious metals without storing physical bars in their basement. The whole system works because everyone trusts that the paper contracts are backed by real metal sitting in approved vaults. But what happens when the metal starts walking out the door faster than anyone anticipated? Silver hit $72.36 per ounce on December 24th. That is a 143% increase compared to the same date last year. The rally wasn't driven by speculation or hype. According to trading data, the surge came from two very real catalysts: expectations of U.S. interest rate cuts and safe haven demand triggered by escalating geopolitical tensions. On December 10, 2025, the Federal Reserve announced its third consecutive interest rate cut, bringing the key rate down to a range of 3.5%. Wall Street analysts called it a quarter-point adjustment. Silver traders called it something else: validation. When Treasury yields drop, the opportunity cost of holding non-yielding metals evaporates. You aren't giving up much by owning silver instead of bonds. That fundamental shift brought institutional money flooding back into precious metals. But here is where it gets interesting. While Comex vaults were hemorrhaging metal and prices were exploding higher, something peculiar was happening across the Pacific. On January 1, 2025, China did something that sent shockwaves through the market. They placed silver under state trading export controls. Translation: Beijing told the world, "We're locking down our silver supply." Analysts predicted shortages. Industrial manufacturers panicked. But then, in October 2025, just 9 months later, China did the unthinkable. They exported 660 tons of silver in a single month. That is the largest export volume on record, straight to London, the exact market they were supposedly cutting off. This wasn't a policy change. This wasn't a gradual relaxation of controls. This was an emergency dump, and it failed spectacularly. Despite flooding the market with 660 tons, silver didn't crash. It didn't even slow down. Instead, it continued its march to $72. So, what is really happening? Why did China reverse course so dramatically, and why didn't their massive supply injection work? The answer is in Shanghai's stockpile data, and it is terrifying. While China was exporting record amounts, their domestic silver inventories on the Shanghai Futures Exchange were collapsing. From 3,900 tons in January 2021 to just 780 tons by December 2025. That is a 75% inventory wipeout in less than 5 years. China wasn't restricting silver exports to build reserves. They were restricting exports because they were running out. And when London's market seized up, they had no choice but to raid what little they had left. Here is what happened behind closed doors in October 2025, the crisis that forced Beijing's hand. The London silver market, the world's largest over-the-counter precious metals market, was experiencing what traders call a physical squeeze. Inventories were so tight that buyers were paying massive premiums just to get metal delivered. London was screaming for silver, and the premium they were offering made it impossible for China to say no. Remember, Shanghai silver was already trading at a 15% premium over Western prices earlier in the year. That spread compensated for China's import tax. But when London offered even higher premiums, the arbitrage became irresistible, or more accurately, necessary, to prevent a complete market breakdown. Daniel Golly, a senior commodity strategist, explained it perfectly. A wave of imports into China is going to drain the free float away from the West even further. Except in October, the wave reversed dramatically. China became the supplier of last resort. They exported 660 tons to keep London's market from completely seizing up. But here is the critical detail most analysts missed. This wasn't a strategic move. This was damage control. This was an emergency intervention to prevent systemic failure. Why? Because even after injecting 660 tons, roughly $37 billion worth of metal, prices kept climbing relentlessly. This reveals the mechanism driving this market. It is not a cycle. It is a death spiral with a mathematical endpoint. Stage 1, China imports heavily. Stage 2, domestic solar boom consumes stockpiles faster than imports can replace them. Stage 3, Shanghai inventories collapse 75%. Stage 4, London experiences a physical squeeze. Stage 5, China exports emergency supply to prevent global market breakdown. Stage 6, prices continue rising anyway because the structural deficit remains. We can prove this with hard numbers that don't lie. According to the Silver Institute, global silver deficits have persisted for 5 consecutive years. The 2024 deficit was 282 million ounces. That is not a tight market. That is a structural shortage where the world is consuming more silver than mines can produce. Where does the missing metal come from? Recycling, stockpile drawdowns, and the slow depletion of above-ground inventories that took decades to accumulate. Those aren't infinite sources. Every ounce pulled from a vault represents metal that won't be available next year. This brings us to the core problem, the physics. You cannot policy your way out of geology. According to Trading Economics, nearly 60% of annual silver demand comes from industrial applications. We are talking about photovoltaic solar panels, electric vehicle components, 5G infrastructure, and AI server farms. These aren't optional luxury uses. They are essential inputs for the global energy transition and technology build-out. For solar panels, you can't use copper paste. It oxidizes and kills efficiency. For high-frequency electronics in AI servers, you can't use aluminum. Resistance is too high. Physics doesn't negotiate. This metal is being consumed. It is not sitting in vaults waiting to be sold back into the market when prices rise. It is being turned into products that will never release their silver back into circulation. It is gone. So, you have industrial demand providing a rising floor under prices. You have investors demanding physical delivery instead of paper exposure. You have vault inventories collapsing at unprecedented rates. And you have Western banks holding massive short positions, bets that silver prices will fall, established when the metal was trading near $70. Here is what should grab your attention. While these banks were shorting silver around $70, expecting the rally to fizzle out like every previous surge, the physical market was already showing them something different. Shanghai prices weren't following New York lower. London vault premiums weren't evaporating. The delivery requests weren't slowing down. The banks made their bets based on historical patterns. They assumed the usual playbook would work. Let the speculators drive prices higher, then flood the market with paper contracts until the rally collapses under its own weight. But you can't flood a market with paper when everyone is demanding metal. You can't suppress prices by creating more futures contracts when those contracts are immediately claimed for physical delivery. The banks didn't just get the trade wrong, they got trapped in a mechanism that is breaking down in real time. You want proof that the paper-physical disconnect has reached crisis levels? Let me show you what happened on October 10th. Comex futures prices traded at a discount of more than $3 per ounce compared to London spot prices. In normal market conditions, that spread should never exceed a few cents, just enough to cover transportation and insurance costs. A $3 gap represents a fundamental breakdown in the arbitrage mechanisms that keep global prices aligned. Traders immediately recognize the opportunity. Buy silver futures in New York at the artificially suppressed price. Take delivery of physical metal. Ship it to London. Sell at the premium price. Pocket the difference. That arbitrage should have been impossible. The very existence of a $3 spread told you that something had broken in the plumbing of global silver markets. It told you the market doesn't believe Comex can efficiently deliver metal anymore. This triggered a one-way exodus. Chinese silver flooded into Western markets, even as Western vault inventories collapsed. That is not normal arbitrage. That is a market screaming that something fundamental has broken in the pricing mechanism. Now, let's look at the math that keeps risk managers awake at night. Comex registered inventory, remember, that's the metal available for delivery, has declined by over 73% since 2020. We are not talking about a gradual drawdown. We are talking about an accelerating drain. On a single day in early December, 7,330 silver futures contracts requested physical settlement. Each contract represents 5,000 ounces. Do the calculation. That is 36.65 million ounces claimed in one day. Analysts noted this represented roughly 30% of Comex's entire free float inventory. One day. Have you ever seen a bank run? Not in movies, but in real financial history? It starts slowly. A few customers get nervous and withdraw their deposits. Then, a few more. Then the line forms around the block as everyone rushes to get their money before the vault runs dry. What happened in December wasn't quite panic yet, but it was the line starting to form. The people claiming physical delivery weren't speculators hoping to flip contracts for profit. They were industrial users who need silver for manufacturing, and institutional investors who want metal they can actually touch. So, where does this end? If delivery requests continue at December's pace, Comex faces a binary outcome. Option 1, prices explode to levels high enough to force metal out of ETF holdings and allocated accounts. We are talking about triple-digit silver. Option 2, the exchange declares force majeure and settles contracts in cash instead of metal. If they settle in cash, it destroys the last pretense of price discovery. It confirms that paper silver is a fiction untethered from physical reality. It would validate every conspiracy theory about precious metals manipulation and likely trigger a cascade of delivery requests from traders who suddenly realize that paper claims might become worthless. January 2026 is when the mathematics become unavoidable. Let's do the calculation for China. Their remaining Shanghai stockpile is 780 tons. Their annual consumption is 19,000 tons. That leaves less than 14 days of visible supply cover for China's domestic industry. Even if they have hidden reserves, we are talking about months, not years, before total exhaustion. Conclusion. China's 60-ton dump was supposed to calm the market. It failed. The Federal Reserve's rate cuts were supposed to be adjustments, but they signaled the end of the strong dollar. The banks holding short positions are trapped. They can't cover without pushing prices higher, and they can't hold without risking a catastrophic squeeze. The mechanism that kept silver prices suppressed for decades, the ability to create unlimited paper contracts backed by minimal physical metal, is breaking in real time. December's vault drain wasn't a one-time event. It was the market's way of saying, We don't trust paper anymore. Deliver the metal. The abundance was a lie. The scarcity is the reality. The system is changing, and the transfer of wealth has already begun. The question isn't if it happens, but where you will be standing when the stockpiles officially hit zero. This is InvestEdge. Subscribe to see what the data reveals next.